Maria opened her 401k app on her lunch break, the same 15-second ritual she's done every few months since she started her job, and for a second she just stared at the number without really seeing it. It wasn't shrinking, it wasn't even flat, it had actually grown, steadily, the way it's supposed to, and yet something about it felt wrong, like looking at a photo of yourself from 10 years ago and realizing your face changed so slowly you never noticed the moment it happened. She scrolled up to her contribution rate, the little percentage she'd set on her very first day at the company, and there it was, 3%. The same 3% she picked in a rush during new hire orientation, sitting in a conference room with free bagels, filling out a form she barely read because someone told her, just do at least 3, that's usually the match. That was 2016. Her salary back then was $42,000. Her salary now, almost a decade later, is $78,000. The percentage never moved, only the paycheck did. My name is Daniel, and I want to talk about a phrase I don't think gets used enough in personal finance, the ghost percentage. Because what happened to Maria isn't a mistake anyone would call reckless. She didn't gamble her retirement away. She didn't panic sell during a crash. She didn't max out a credit card on things she didn't need. She did something quieter and far more common. She set a number once, at the least informed moment of her entire career, and then let inertia run the rest of the show for 9 years straight. Here's what makes this so sneaky. Every time Maria got a raise, her take-home pay grew, and her brain registered that growth as more money to work with. Rent went up a little, groceries went up a little, she upgraded her phone plan, she started getting the nicer coffee instead of the gas station stuff. All small, all reasonable, all the kind of decisions nobody would blink at individually. But her 401k contribution, frozen at 3% of a growing salary, never got its share of that raise. In dollar terms, 3% of $42,000 was about $1,260 a year. 3% of $78,000 is about $2,340 a year. That sounds like an increase, and technically it is. But here's the part that should bother you. If her raises had simply kept her contribution rate constant as a percentage of what she was capable of saving as her income grew, and if she'd nudged that rate up even 1 point every couple of years, the way a lot of financial planners quietly recommend, she'd be contributing closer to 8 or 9% by now. On her current salary, that gap between 3% and 8% is roughly $3,900 a year she's simply not putting in. Over the remaining 30 years of her career, assuming nothing wild, just average market growth, that missing few $1,000s a year compounds into a difference of literally hundreds of thousands of dollars by the time she retires. Not because she made a bad investment, because she never revisited a decision she made in 15 seconds with a bagel in her hand. And this is where I think the standard finance conversation gets it backwards. We talk endlessly about which fund to pick, whether to go aggressive or conservative, whether index funds beat actively managed ones. Those conversations matter, sure, but they're arguing over the seasoning while the actual meal is getting smaller every year without anyone noticing. The contribution rate is the meal. The fund selection is the seasoning, and somehow we've built an entire culture around obsessing over seasoning. There's a psychological reason this happens, and it's not laziness, whatever the finance bros on your feed want you to believe. It's called anchoring, and it's the same reason people negotiate furiously over a $50 cable bill, but won't spend 10 minutes adjusting a number that affects their entire future. The 3% Maria picked wasn't really a decision. It was a default she inherited, the way you inherit a ringtone you never bothered to change. Once a number like that gets set, your brain quietly files it under handled. It stops appearing on your mental to-do list. Meanwhile, your salary, your rent, your subscriptions, your whole lifestyle keeps moving forward, recalibrating constantly, because those things demand your attention every single month. The 401k doesn't demand anything. It just sits there, patiently letting you forget about it, which is exactly why it's the first thing that falls behind. Now, here's where it gets even more interesting, because I don't think this is really about 401ks at all. I think retirement accounts are just the clearest place to see a much bigger pattern in how people handle money, which is that we upgrade our spending automatically, but we upgrade our saving manually. Nobody has to remind you that a slightly bigger apartment feels nice, or that DoorDash is easier than cooking after a long day, or that the new phone has a better camera. Your lifestyle creeps upward on its own, quietly, one convenience at a time, without a single meeting or form or decision point. But saving more money requires you to actively go find a settings page, actively type in a new number, actively choose discomfort today for a benefit you won't feel for decades. One of those paths is frictionless, the other has a locked door in front of it. Guess which one wins by default almost every single time? If you're finding this kind of thing useful, by the way, this is exactly the sort of thing I like digging into on this channel. So if you haven't already, go ahead and subscribe, because we get into stuff like this every week, the quiet mechanics behind money decisions that nobody else bothers to explain clearly. Let's push this a little further, because there's a second ghost hiding right next to the first, and it's almost funnier once you see it. A huge number of people set their contributions into what's called a target date fund, something with a year in the name, like 2055 or 2060, and they treat it like a crockpot. Set it, walk away, come back in 30 years to a finished meal. And to be fair, that's roughly how it's designed to work. The fund automatically shifts from riskier investments towards safer ones as your target year approaches. The problem isn't the tool. The problem is what people assume the tool knows about them. That fund has no idea Maria plans to retire 5 years early to help care for her aging mother. It has no idea she's terrified of market drops and would panic sell in a crash if her portfolio were more aggressive than she can emotionally handle. It has no idea her husband has a pension and she doesn't, which means her risk tolerance should look completely different from a coworker with the identical fund and the identical target year. The fund just sees a date. It assumes you're an average person with an average temperament and an average life, which is a little bit like buying a suit off the rack and assuming it fits because the tag says your size. Sometimes it does. Often it's just close enough that nobody complains. What strikes me about both of these ghosts, the frozen contribution rate and the borrowed risk tolerance, is that they're invisible because nothing bad appears to be happening. There's no red number flashing on your screen, no alert telling you you're behind, no crash making headlines. Your balance goes up every year, slowly, quietly, just enough to feel like progress, which is exactly why it's so easy to never check whether that progress is actually on pace with the life you're planning to fund. A stock market crash is loud and visible and terrifying, and because of that, people actually react to it, sometimes badly, but at least they react. A ghost percentage sitting 3 points below where it should be doesn't make a sound. It just quietly costs you a house's worth of money over 3 decades, while you feel completely fine about your financial life the entire time. So what do you actually do with this? I'm not going to sit here and tell you to go be aggressive and dump 40% of your paycheck into your 401k tomorrow, because that's not realistic for most people, and honestly, it's not even the point. The point is smaller and more achievable than that. It's going back into that account right now if you can, and actually looking at 2 numbers, the percentage you picked on day 1 and the percentage that would actually reflect the raises you've gotten since then. For a lot of people, that gap is bigger than they expect, and closing even half of it, bumping your rate up 2 or 3 points, adjusting it again next time you get a raise instead of letting the raise just evaporate into lifestyle, is the single highest leverage 5 minutes you'll spend on your finances this year. Some plans even let you automate the increase itself, a setting that bumps your contribution up automatically every time your salary rises, which essentially builds the discipline into the system so your future self doesn't have to rely on your present self remembering to care. Before you go, if this kind of breakdown is useful to you, stick around and subscribe, because this channel is basically dedicated to finding the quiet stuff hiding inside your financial life that nobody else bothers to explain clearly. What Maria's story really shows isn't that she failed at anything. It's that the systems we're handed, the defaults, the auto-enrollment percentages, the target date funds with their generic assumptions, are all built for an average person who doesn't actually exist. And the only way to close that gap is to occasionally go back and check whether the number you picked years ago still has anything to do with the person you've become. So here's what I actually want to know from you. When's the last time you checked your own contribution percentage? And if you found out right now it was still set at whatever you picked on your very first day, would you even be surprised?